Okay, so we just finished part 2 of the presidential election and your retirement, where we talked a lot about the what ifs. What happens if the Tax Cuts and Jobs Act expires as of December 31st of 2025? What kind of implications does that have to you in your retirement account? Most people have the vast majority of your retirement wealth within your pre-tax 401k plan. That means it's never been taxed before, which means you could have a huge tax bill depending upon any tax strategies you do or do not put into place, and dependent upon what tax rates you will pay when you take that out, which everybody knows the presidential election can have implications. I gave a board example during this show that gave a specific example of how you could take advantage of tax rates while they're on sale. And I've been talking about how tax rates have been on sale now for the last 6 years since we had the tax rates cuts that started January 1st of 2018. So go ahead and check out the full show and take away some of the strategies that you could implement potentially immediately to help you on your way to retirement. What happens in Washington can impact your retirement. Usually what happens is every so often we're going to have some landmark legislation that's passed that's really going to shake things up as far as what you might do from a savings strategy or even a distribution strategy from your accounts. But over the last 6 years, we've seen a lot of legislation that has had a big impact. As an example, the Tax Cuts and Jobs Act that was passed starting 2018, that was a big piece of legislation that had a lot of implications. And then just 2 short years later, 2020, is when Secure Act 1.0 took place, which had many retirement planning provisions that adjusted. And one of the biggest provisions that I think was probably a big negative to a lot of people, especially in an environment where we're seeing the biggest transfer of wealth that this country has ever seen, is what took place with the Stretch IRA. Prior to Secure Act 1.0, if you inherited money, you could take distributions out of that IRA over the course of your lifetime based on your life expectancy. That's what most beneficiaries of IRAs had the ability to do, which means your distributions that you took out of the IRA could be taxed at your tax rates based on your life expectancy, and you could stretch those distributions out over the course of your entire lifetime. And then when you pass away, you could pass that on to your kids. They could take those distributions out based on their life expectancy over the course of their lifetime. And that was a strategy that was deemed the multi-generational IRA, because multiple generations could benefit from that single IRA. Enter Secure Act 1.0, which virtually eliminated that stretch provision for most people. So now, most people, when you inherit an IRA from somebody who's been receiving a required minimum distribution, you have to start taking a distribution out of that IRA, and the entire IRA has to be emptied by the end of that 10-year time frame. So virtually after 10 years that you receive this IRA, you have to have that down to zero, otherwise penalties are applied to the remaining balance. If you receive an IRA from somebody who has not begun their required minimum distributions, then you don't have to take out a distribution each and every year, but still you have that 10-year time frame that entire IRA balance has to be down to zero. So that eliminated a big opportunity for a lot of people to transition wealth to generation. And what it did is it decreased the time frame of which you had to take this money out of the IRA, which means it could potentially cost people tens of thousands of dollars of taxes over the course of the life of that IRA. And then just 2 short years later, 2022, Secure Act 2.0 came into place, which had over 90 retirement plan provision implications. And I think Secure Act 2.0 was actually a much better provision or law for most people, because amongst many of the changes that it made, it did allow people to push out their required distribution till further down the line. As an example, many people had to take their required minimum distribution from Secure Act 1.0 at the age of 72, but enter Secure Act 2.0. Now, if you're born between 1951 and 1959, you don't have to take your RMD until age 73. And then if you were born from 1960 and beyond, your required minimum distribution doesn't have to start until age 75. So that is one example of a benefit that Secure Act 2.0 took into place. But because there's so many different legislative provisions within all of these laws, it's just nearly impossible to keep track of what these provisions have. However, we do know elections have implications to your retirement plan, which is why you need to pay attention to the legislation that is enacted and then adjust your plan as that takes place. What happens if the Tax Cuts and Jobs Act does expire? What we're not going to do is just throw our hands in the air and say, whoops, there's nothing we can do about it. Let's just continue on our way without a plan in place. There are still going to be many strategies that you can implement to take advantage of whatever that environment is at that time. We need to pay attention to that legislation, see what really comes to place with that legislation and other pieces of legislation that could be enacted. But we do know, as an example, if the legislation does expire, then 5 of those 7 tax brackets or tax rates are going to increase. So 5 of the 7 tax rates are going to increase, but as an example, the 12% tax rate that exists today is going to increase to 15%. So implementing Roth conversions or other tax planning strategies post-2025 still can be a good deal. It's just instead of paying 12%, you might pay 15, or instead of paying 22, you might pay 25. But those are the tax rates that we're going to have available to us for the foreseeable future. And if you ask 10 people, do you think tax rates are going to go up before they go down? 9 out of 10 are going to say tax rates are probably going to go up before they go down. So if we have to pay 15 or 25 as opposed to 12 or 22, then that's the environment we're in. There's still a lot of tax planning strategies that can be effective for you. You have to take advantage of those. And so even if the tax legislation does expire, we're watching it and we'll implement strategies that are appropriate based on current legislation and legislation that we anticipate will continue to come down the road as we go. Okay, in this video we have some breaking news. The breaking news is that the IRS just announced that if you inherit an IRA from somebody who has been taking their required minimum distributions, you do not have to take a required minimum distribution this year. So earlier in this video I said part of Secure Act 2.0 is that they mandated you take a required minimum distribution each and every year, and then that balance has to be down to 0 after 10 years. That was true, but they came out with another waiver this year that says if you inherited a post-Secure Act IRA from somebody who's taken the distributions and you otherwise were mandated to take it out, that waiver applies to this year as well. We will plan on, as a part of our planning, that next year we're going to have to take those distributions for people in that situation, but we will continue to watch the legislation to see if there's another waiver granted next year. It is important to remember, however, even though you don't have to take the required distribution this year, the IRS still expects that you're going to have that balance down to 0 by the end of that 10-year time frame. All of this stuff is going to take place, and you can control very little of this legislative changes. What you can control is whether or not you have a plan in place. And if you have your retirement plan in place, when these things that take place that are outside of your control happen, you can start from where you're at in that plan. This stuff takes place, the legislation changes, something in your health condition changes, you're forced into retirement for a lot of different reasons. If you don't have a plan in place, now you're starting from scratch. You're starting from 0. So have a plan. If you don't have a plan, get started with creating your retirement plan. And as we go through these time frames and all of these changes that are inevitably going to take place, it's going to be much easier for you to adjust as you go. If you have any questions about any of this and you want to talk direct with a retirement planner about your situation, about your questions, it's very simple. All you have to do is go to retirereadycall.com, sign up for a time that is convenient to you, and you can have that conversation and help get you on your way to and through retirement. Retirereadycall.com, you'll have a great conversation.